and while sort of considering fixed income as an investment class, them being what is the coupon, face value, the maturity rating, and the yield. So this was the first very basic sort of session we had. Then we moved on to how do we assess, align, and achieve our goals via fixed income. In assessing, we sort of spoke about the credit quality of the investments, the liquidity aspect of the market dynamics, and the interest rate scenario and how it affects the bond prices. From there, we moved on to how do we align, our investment goals and take advantage of fixed income market. We sort of discussed what sort of goals one should have, and how do you sort of do your risk analysis and consider different asset classes, and where does fixed income fit in that particular valuation, and what are the advantages of fixed income market. And then obviously, how do we achieve? Then we spoke about types of bonds, various types of bonds that are available in the market. How do we analyze an instrument, the quote of that particular instrument? What are the parameters that go into, sort of, evaluating the final price, etc., etc. So all these already is there live on our website. So if any one of you have missed, you can go back, sort of go through all those videos. And post covering all the basics, I sort of thought, I'll sort of talk more about or give you an insight about the corporate bond market that India currently has, and what are the few insights, where it stands, what are the dynamics this market has, and what sort of future does this market hold. Corporate bond market insights, dynamic in future. Uh, so basically, just to give you an overview, right? We have to understand India. We all agree India is one of the fastest growing economies, right? Recently, also there was a revision of India's growth numbers by RBI. In FY23, we already sort of overcame UK to become the fifth largest economy. Now we are aiming to be a third largest economy, or a 5 trillion or a 7 trillion economy, right? Now, one thing we have to understand, right? When an economy is trying to sort of grow in a very, sort of a fast pedestal, there are multiple variables that sort of help it, right? We have to understand growing an economy, meaning we need a lot of money that needs to be flowing in the economy for, all the businesses to sort of grow, and obviously, respectively, the individuals and everyone in the economy sort of grows, right? So investment in the economy has to keep on coming from every place possible, right? So funds need to be pumped into the economy for it to sort of invest in maybe various infrastructure projects, or anything that we want to sort of do, and subsequently that benefit is passed on to the final consumer, or individuals like us, right? Now what is happening, the money that is flowing in Indian economy, or the money that is being borrowed by a lot of these corporates, mainly are borrowed from banks or financial institutes, right? Now this money flow that you have to understand, majority of the money flow in the economy is from financial institutes, be it banks, or financial institutes, so on. Now what happens is, after a point, right, there is the risk for all these financial institute will sort of reach a limit wherein they won't be able to pump in more money. Now what happens then, right? We need a lot of money coming in from individuals, or everywhere possible, right? So now getting money from individuals, one of the best way, or one of the important vehicles is fixed income, right? Like, finally, obviously banks are lending, financial institutions are lending. We need individuals also to start, individuals, HNIs, to also start lending to all these corporates, so that they can use that money and sort of grow. So having a very good or a solid fixed income market is a prime importance for any economy who wants to grow at a fast pace. And corporate bond market is one of the best as I said, central agency is already taking a note of it, and things are moving in that direction. Um, so moving on to the numbers of fixed income market. So if you see, the outstanding bond market currently, majority of the issuances are by G-Secs, and more money or raise more money. Obviously, banking channels already providing that money will also should be coming from almost everyone in the economy. So obviously this number is slowly increased. Initially it was, I think, sub 20 or sub 18. Now it's already gone to 22%. Uh, Now the expected growth of corporate bond market, right? It's expected to sort of grow twice as much by the end of next year, 2025. We are already at 45 lakh crores of outstanding corporate bond issuances, and which is expected to grow to almost 65, 70 lakh crores. Now the number of issuances, right? Why I would put this chart also here is, it's very easy for a AAA rated entity to sort of raise money from the market. And it's very easy for them also to sort of get that, confidence from the market, and, there will be multiple investors sort of willing to put money in. Now, what is changing here is even the lower rated instruments or corporates have started to raise a lot of money. So if you see the number of issuances, obviously the amount will still be higher of AAA rated issuances. But what is changing is, more and more that sort of confidence even the corporates have started to sort of get. And we'll see this trend sort of growing more and more here on. Just to give you a comparison, in US the AAA rated entities, or the amount of money that AAA rated entities raise, it's much lesser than what it is raised by the AA or below rated entities. So we are moving in that direction, and we'll see more and more issuances coming in, more and more participants sort of participating, and we are fixed income market is sort of slated to grow. From here, we were obviously at a nascent stage. I could have said we were at a nascent stage at least 2-3 years back, but I think we are on a growth path right now. And from here on, you will see this trend changing, and corporate bond market sort of booming from here on. Again, as I said, the corporate bond market outstanding, it's slowly already sort of increasing. We are already at 45 lakh crores. And the sort of investor base that we have in this corporate bond market, if you see the second chart, it is still a lot of institutions, banks, or mutual funds or qualified institutional investors are still investing more in corporate bonds, and sort of retail participants in somewhere is still very low at around almost 5.5%. So as I said, we are on a growth path, but still there is lots for this sort of corporate bond market to left for them to achieve, basically. Just on the last slide, if you see last chart, if you see the percentage of corporate bond outstanding versus the GDP of the country, India is still way behind, right? We are even behind Thailand in Thailand or Vietnam, or almost at par with Vietnam. So even developing economies are much ahead in this particular corporate bond space. So yeah, there is still a lot left. And again, still dominated by institutions, be it insurance companies, banks, or mutual funds. And this trajectory slowly will sort of change, and once this trajectory changes, India will soon again become on the forefront of growth, because a lot of money will flow in, and subsequently the growth will come. Then few signs. I just also wanted to sort of give you an understanding of when I say things have changed. There are few signs that you sort of need to look at wherein you can get a confidence of if the market is really, up for it, or is it maturing or not. What does maturing, market, what do you constitute as, a particular market is getting matured? Uh, First and foremost, obviously, is, you need a lot of participants. More the participants, meaning the market is sort of matured and the price discovery is very fair. Things are in place. It's very easy, accessible, highly liquid, etc., etc. Right? So if you see the first chart that I've put here, the yields are sort of, mirroring the trend of the repo rate. The green line here is basically the trend of repo rate. And if you see, at least AAA and AA plus uh, securities are mirroring this trend. What this means is, if the benchmark rates are changing, the rates for these AAA and AA entities or securities are also subsequently changing in line with the change that is happening. Meaning, you value, or there's a benchmark that is being followed. So basically, participants give a lot of importance on where the benchmark rates and sort of follow it, right? So that trend is emerging now more, giving the confidence that market is slowly starting to mature. Then obviously the composition of listed and unlisted. So these are the volumes that have been traded in all these years of listed and unlisted instruments, corporate bonds. If you see, the listed has slowly been increasing at a very high pace in comparison to unlisted, meaning people are willing to sort of wanting to have the price discovery in the most fair way, right? Unlisted, it's very difficult to sort of understand, follow where the market trend is or what the right price is. Once it is listed, the data is out there available for everyone to see, and every price discovery sort of becomes very fair. Um, so that has sort of increased, and slowly if you will see, the listed space will slowly even go, sort of go lower, and unlisted, there'll be a time when there'll be only listed, sort of the volumes in listed will be very high, and listed will be high, very negligible. Mostly will be private placements wherein they don't even need money from public or institutions. Now, second, as I said, the need of having more participants is very important for a market to mature. So now, what used to happen at least 2 to 3 years before, all these corporate bonds would have a face value of 10 lakh rupees, most of them. What does this mean is, if an investor has to invest, he will need minimum of 10 lakhs rupees to sort of, participate in that particular issue. Now, as a rule, SEBI has come up and said all corporate bonds need to have, face value of 10,000 rupees, meaning the 10 lakh minimum threshold has gone down to 10,000. So even a person having 10,000 can sort of participate. From 10 lakh, obviously, slowly moved to 1 lakh, and then currently now it is 10,000. Now, so basically, online bond platforms are also come up, right? Wherein sort of, players are forced to sort of have certain set of volumes to be traded in these particular platforms, like EBP platform, RFQ platform, wherein all the traders, all the participants, uh, basically mutual funds or prop desks, insurance companies, they need to trade certain volume of their monthly volume on these platforms to sort of increase liquidity. So more and more there is a liquidity in the market, and more participation comes in. And recently, a few years back, a lot of these online bond platforms had come up, wherein they would sort of help investors invest, or buy or sell bonds online. Recently, a huge set of regulations have come in on how these entities are supposed to be sort of operated. So giving the signs that these market is maturing, the agencies are taking note of it, understanding the importance of the market. So even the good part is, even the central agencies are understanding the same aspect, and somewhere investor community is also slowly sort of understanding, and more participating coming in. So as I said, we were somewhere at a nascent stage, but right now we are on growth path, and things are going to sort of move forward from here on. This is where the corporate bond market sort of is positioned right now in India. So moving on to the outlook or the fixed income outlook, uh, one before giving you the outlook, what is the sort of basic thing that one need to understand uh, to sort of form an opinion on where the market is heading? We have to understand. So RBI has a obviously RBI, apart from sort of being a regulator or having being a watchdog on financial institutions. Uh, one of the tasks, one of the many tasks that RBI also has is sort of balancing, growth and inflation. And we had already spoken about this in our last sessions, but just for the benefit of everyone, I'll sort of re-explain that concept. Uh, so basically, RBI cannot only focus on either controlling inflation or promoting growth. It has to have a balance between the two. What does mean is if economy is growing and central agency or central bank keeps promoting the growth. Uh, what happens is there is obviously money in the hand of final consumer or an individual who will sort of go out and spend that money. So basically what will happen is demand will increase and supply will reduce, leading to sort of high inflation. Now high inflation again is a problematic scenario in an economy, because obviously there are a lot of individuals, a lot of things that get affected due to high inflation. uh, Obviously we have to have a very like a balance or a like a balancing inflation, so that the growth is also not sort of hampered, and even individuals or the country is also sort of not affected. Now how does RBI maintain this balance? It maintains this balance by increasing or decreasing the repo rate. So for example, if the repo rate is increased, meaning the cost of borrowing goes up. If the cost of borrowing is up, uh, in general, this is a sort of a macroeconomic sort of a example. If the cost of borrowing increases, corporates won't or will shy away from borrowing more money, meaning more less money will get invested, meaning the businesses won't grow as much as they would have liked to, subsequently sort of leaving less money in the hands of end individual. The reverse scenario, if the rates are low, meaning corporates will borrow more, meaning the growth will increase, meaning there will be more money in the hands of individuals, meaning the consumption will increase, meaning the supply demand will get affected and inflation will sort of go off. Uh, so this is the balancing act that they have to sort of play. So RBI has inflation number in their mind, which is sort of their comfort zone, which is 4% plus minus 2. Basically, the band is 2% on the lower side and 6% on the higher side. So what is happening right now is uh, inflation has been very sticky for a very long time for various reasons, right? So inflation number has been above 4% for a very long time. It was much higher earlier. It has slowly gone down. Last month, the inflation has come down below 4%. Mostly food prices have been very haywire, and that has been leading to high inflation numbers. Now this inflation number of 4%, below 4% of 3.54, that has come in last month. This needs to stay consistent for a while for RBI to sort of consider the rate cut. Right, the rates right now are at peak. So basically, RBI has from 2022, they post obviously COVID, they wanted to promote. Initially during COVID, they had to drop the rates significantly. That led to obviously very high inflation, and to obviously control or put brakes on inflation. Central banks across the world had started increasing the rates, and now the trend is that most of these central banks have started to reverse those rates. India has really not followed what the West world is doing. Obviously, because we never increase the rate as much as, decrease the rate as much as, other central banks had sort of decreased. So what is happening right now is on the other side, uh, if you see the rate, India's growth is still very intact, right? It is still very robust in comparison to various other economies. So the need to sort of promote growth is not a high priority for RBI right now. If you see, look at inflation, inflation has consistently been above the 4% level. So controlling inflation has been the focus area, and time and again, the RBI governor has come out and said, they their main focus is to get inflation under control, and they are working towards it. And when the right time is there, they'll sort of change their stance if needed. So as I said, this inflation number has to consistently sort of be below 4%. What sort of affects inflation, or why is inflation so high right now? As I said, food inflation has been very sticky, and obviously the thing that is going to help food inflation sort of cool down is good rain. So, right now all the economists or everyone who's tracking the interest rate scenario will be tracking how good the rains that will be in India, and what sort of impact this will have on the food prices, and subsequently, obviously, inflation. So this is where we are. Uh, uh, what we see is, you know, sooner or later RBI will have to start concentrating on growth. Uh, Obviously, I feel inflation. Uh, the rains are obviously you know as uh, as expected, like the amount that is required. uh, the charts already show the rains have been above normal in most places, so food inflation might not be as sticky. So this 4% comfort zone of RBI is where sooner or later will be sort of consistent, and we see interest rate cut happening in maybe next, or in coming few quarters basically, and the rate reversal uh, will sort of start happening. What happened last month in the bond market is, obviously, in the anticipation of rate cuts, the yields have been consistently sort of going down for a while. Even last month there was a very gradual 7 bp rally that happened in the month of August. And this again, for if you see from April, the yields have fallen quite consistently, but towards the end, after July, August, they've been very range bound, because the anticipation of rate cut had started from much earlier, and that sort of gets priced in. But right now, all of that rate cut sort of market expectation was there, it sort of looks like it is priced in, and it is sort of range bound right now. So only when now finally the rate cut will happen, we'll start seeing the movement in the yields. Uh, if you see the yield curve, we are well placed. Our short-term sort of rates are lower than the long-term rates. Uh, and as I said, RBI will have to sort of come up and somewhere start promoting growth. So we envisage the rate reversal cycle happening anytime soon, and we'll see the yields falling further. Uh, so now, as I said, we already expect the rate reversal cycle. So now why is this important, right? This is a very crucial opportunity. Now what happens is, if the rate cut happens, meaning all the yields that are there in the market will sort of start falling down. So you are at the peak of the quality yields. So now is the time for all of us to sort of consider investing, because from here on you won't see such yields coming for a while. Just to sort of give you an overview of how the transmission is affected bond market. There's a stable, on the left, in 2021 the repo rate was around 4%. Currently it is at 6.5. If you see 10-year GSEC then was around 6.21. Currently it at 7.08. So if you see subsequently, all the rates sort of have increased over the period of the time as the rates have increased. So basically, rate transmission is very effective in our bond market, and sooner or later, when the rate cut happens, if it happens, we'll see that happening here. So there are two sort of advantages that investor will get if invested now. Is one, obviously you will get quality yields from a quality instrument, which will sort of diminish as rate cuts start happening. And finally, there is a opportunity of capital gains also, because as the yields fall, the prices increase. So invested now, meaning if the rate cut happens, the price of your bond will increase, and there is an opportunity for capital gains also. So this is where we stand, and it is important for us to sort of consider fixed income market now, sort of to take the uh, benefit out of this market. So yeah, that's it from my end. If there are any questions, I would be more than happy to sort of answer.
Thank you, Sachin, for an interesting session. Now, I'd like to ask everyone who've joined, do you have any questions for Sachin? You can put them in the comment box, please, if you've got any questions. No questions? All right, then.
Okay. Thank you
So
very
as we Yeah, sorry. Just a final concluding statement from us. As we conclude this session, let's apply this newfound understanding to make informed financial decisions. To all attendees, thank you for joining us. Let's continue this journey of learning together. Stay informed, stay inspired, and stay empowered. Keep an eye out for our next informative webinar. Until then, stay connected with us for more updates. Thank you so much for being part of Yes FinPulse webinar today. And thank you so much, Sachin, for such an interesting and enlightening session. Thank you very much.